it's going to ramp up really fast. What some of you may not know is that it's not just the French who take off the month of August. It's also venture capitalists. I used to try to fight that. I don't try to fight it anymore. VCs just don't work in the month of August. Having said that, I wanted to point out a couple of things. I thought this was interesting. First, you all know Zynga, right? That's the big company that's doing a lot of work on Facebook. So Zynga...
7-Eleven.
What's that?
And 7-Eleven. They have a huge deal with 7-Eleven.
Okay, so a deal with 7-Eleven. There have been 5 venture funds that have basically raised their funds around the fact that they had invested in Zynga. And I find that pretty interesting, just because it's fairly random whether or not you would invest in Zynga or not. And let's face it, 2.5, 3 years ago, Zynga was a little game company that decided to put some games on Facebook. And now it's worth $5 billion, according to the last valuation. And a bunch of firms basically went out and said, we know you don't like venture capital, but look at this deal. You can go from 0 to 5 billion in 2.5 years still, which is kind of going back to almost the bubble days. And so 5 firms have raised a lot of money based on just that. Another stat that I saw the other day that I thought was really interesting, I don't know how many guys invest in hedge funds, but hedge funds, mutual funds, venture funds, they're all kind of known as investment vehicles where the top performers tend to generate the vast majority of the industry results. And that's fairly true in venture, but I just saw a study for hedge funds that I thought was really brought that point home. There's about 8,000 hedge funds. There were 12,000, now there's about 8. And some guy did an analysis from 1969 to 2009. And what he looked at was just the top 100 hedge funds, the managers of those funds, and said, how much of the industry's returns did they generate? And those 100 guys, out of a total of 8,000, generated 75% during that period of the industry's returns. Now that's really interesting. So what you'd say is, wow, so if you're in those funds, you'll do well. Well, that's what's strange. The average investor in those funds didn't do so well. And you say, well, how can that be? It's the same problem you have in venture funds and the same problem you have in mutual funds, which is people invest in the funds right after they've had a great year, and then usually right after they had a great year, they have a crappy year. And they have a crappy year because their funds usually go from $1 billion to $5 billion because they get flooded with money. Then the returns do poor, then everybody gets out of the fund, and they go to the fund that did really well that year, and you see how this goes. So on average, they generated around 40%, actual investors, 40% of the returns that the top 100 firms did, even if they were in those funds. So it shows you, by the way, this same phenomenon has been played out again and again in mutual funds, where the top performing mutual fund from 2000 to 2009, a 10-year period, that fund did like 28%. It was a pretty big mutual fund. I forget which one it was. It did 28%. And the average investor, by the way, year over year, the average investor in that fund lost money.
Why?
So, well, that was it, because the average investor was only in the fund for like 13 months. And the fund went like this. It went up and down, up and down, up and down. And people got in perfectly at the wrong time and left perfectly at the wrong time.
What's the lesson?
So, well, the lesson to me is you look at the practices of the fund and you say anytime, you've heard this again and again, a 1-year, 2-year, even a 5-year horizon for alternative investments is just a ridiculous horizon to invest in. You have to say, do I believe in the approach these people have and the processes they use, and by the way, in the tenure of the team, and say, okay, it's a 10-year horizon. There's a reason venture funds have 10-year funds, because during that 10-year period, there is going to be a point where you would sell your portfolio for 50 cents on the dollar. That's just the way it is. During that 10-year period, you're going to see something go like that. And so I've always said to my LPs and to LPs I know who are getting in this space, in some ways, it's really a blessing you're locked in for 10 years, because you would exit if you could. And your impulse would be to exit at exactly the wrong time, right? Wanted to call out a couple other things that I thought were interesting on a micro level. So Facebook, everyone knows the battle between Facebook and Google, right? And let's face it, this is fascinating to me. Facebook basically created Zynga, right? Because Zynga made all of its money off of Facebook. Now, by the way, Facebook finally got smart and they're extracting a 30% tariff on all transactions that go through Facebook. Used to be free, and now they extract 30%. Zynga still thinks it's going to do okay because so much traffic's on Facebook. But the reason why Google is nervous about Facebook, you consider them really two different companies, but in 2009, August 2009, Facebook had about 5% of the time a person spends on the web, 5%, which is actually a lot, right, was spent on Facebook on average. And now it's almost 10%, right? So that's, doubled in a year.
Saying something like, 100% of all divorces are caused by marriage. Like, duh. You're supposed to buy out of Google. Your job is to get off of Google. Your job is to get on to Facebook.
Right.
It's a really stupid number.
So here's the number with Google. Google was generating last year 10% of the time people were on the web, they were on Google, right? And that's either Gmail or search, right? And that figure is the same number now. It's like 9.3% last year, it's 9.3% this year. So Facebook has doubled, right? Now Facebook has now become the largest display ad property in the world. And as you know, Google bought DoubleClick because it wants to get in display ads. What some, you may know or may not know, Google basically makes no money on display ads, right? That was like the Yahoo thing, now Facebook. They make all their money on, pay-per-click. So at some point in time, Google has decided, now I guess is the time, they're going to try to create a new Facebook. My own view is that, hey, Facebook is a unique property. They're not going to be able to do it. But, of course, Google is generating 15 to 18 billion of cash flow a year. They're probably going to spend a lot of money trying to get and do what Facebook did. And that leads me to all the cash that these companies have. We talked about this a few weeks ago. Tech companies have a massive amount of cash, right? If you look at from Google to Yahoo to EMC to Cisco, massive amounts of cash. What's interesting to me is since that cash hoard has really been generated from about 2002 to 2009, the tech stock multiples have been plummeting. And this is probably for two reasons. One is people are saying the reason you have so much damn cash is because you have nothing to invest in, because the growth is limited. But the other reason is because historically companies that generate a lot of cash on their balance sheet do poorly. And the reason they do poorly is because when they have a lot of cash, they tend to get sloppy. It's hard to tell people we can't give you raises when you're Microsoft and you have 50 billion of cash on your balance sheet, right? It's hard to tell a company you're going to buy, hey, we're really poor, when you got 40 or 50 billion dollars of cash on a balance sheet. So an analyst at Bernstein has suggested that if you look at historical performances of companies that had a cash balance and then reduced it, that companies could get up to 70% lift in their multiples if they disgorged the vast majority of their cash via a dividend. And so Chambers, who the CEO of Cisco, has said, we soon will get rid of our cash, or soon we'll dispose of our cash. Now, I don't know if that means they're going to buy something, or if that means he's going to start paying dividends. But either way, going back to venture capital, I think this is a good thing, because this cash sitting on the balance sheet, let's keep in mind, is earning about a 0% return. And as soon as inflation happens, it's going to be a negative return. So you can either buy a fast-growing company, or you can give the money to shareholders, and all managers hate giving money to shareholders because then they can't spend it. So my guess is they're going to start using a lot more of that cash to do M&A.
But haven't they already announced they're going to try to spend about $10 billion over the next 18 months?
Cisco
is.
Yes.
And they've already bought really unique properties. Think about curb to hand. From flip to all the way to the current.
Weird in some ways, I think,
Yeah.
the properties that they're buying.
Yeah.
These are not traditional hardware type properties. Because keep in mind, Cisco's biggest problem is it owns 70% of the Ethernet switch market. And who is the fastest growing company in the Ethernet switch market? Huawei, a Chinese